So why, when you're shopping for a mortgage, do you get all kinds of different rates from different people? Really, just to kind of understand kind of behind the scenes on how this works, ultimately the market drives the mortgage rate. The reason that you get a lot of different rates or some subtle differences really comes down to whether or not the mortgage broker or the lender, listening to your particular goals, will buy up sometimes or buy down the rate. So let me talk a little bit about how that works. So mortgage rates come in at the market rate, okay? So that's generally what you would pay if you were going to go ahead and pay all of the expenses of the mortgage. You're going to pay for the fees, you're going to pay for the closing costs, you're going to pay the loan origination fees. Oftentimes, however, let's say that's 4%. Oftentimes, when you're talking to the mortgage loan officer, you will say things like, well, I want the lowest closing cost. And so in order to accomplish that goal, they'll actually buy up the rate, and maybe they'll give you a 4.25, or they'll quote you a 4.25, because the credit in that rate will actually offset some of the cost of the loans. Because generally in the cost of the loan, there's not a lot of variability. You're paying for title insurance, you're paying for title costs, you're paying for appraisals and credit reports. So there's not a lot of things that can actually be sort of taken out of there. So in order to accomplish your goal of lowering your closing cost or not having any closing costs, they'll actually lift the rate to something a little bit higher. Sometimes, however, in talking to you about your goals, you'll say, I want the very lowest rate possible. And so as a result, they'll actually buy down the rate. In that case, you're actually adding to the cost of your loan. You're going to cover closing costs, but you're also paying to lower that rate below the market rate, in which case your closing costs and fees will go up, but you will have accomplished the goal of the very lowest rate. So it's really important when you're comparing loan estimates, which is the only way to compare loans. When you're getting a loan estimate from a loan officer, it's really important to see which of your goals that you probably conveyed to them they're trying to match and accomplish. So if you were to just say, hey, I want the prevailing market rate, you would get exactly the same rate for the most part across all different lenders and brokers. But be wary when you ask for, I want the very lowest loan rate, or I want the lowest closing cost, because that will sort of define the spectrum. And you can't have, it's sort of that three-legged stool, you can't have all of the above. You can't have the very lowest rate and the very lowest closing cost, because there are fees and costs within that loan. So it's really important to understand what you think or what you're telling your loan officer is most important to you. And that's why you get a lot of variability in the rate quotes that you get back, because you probably conveyed slightly different goals to each of those loan officers.